Assalamu alaikum. This is Khadijatul Jura welcoming you all in the class of capital budgeting and its process, chapter 5, class 9 and 10. In this class, today we are going to discuss about capital budgeting, its process, and the average rate of return method. At first, we will know what is capital budgeting. Capital budgeting is a process related with long-term investment decision. This decision process starts from the purchase of fixed asset and include modernization, replacement of this asset, etc. Fixed asset, business expansion, new product development are also within the scope of this decision. Application of capital budgeting. We need capital budgeting for some reasons and also for some cases. In the case we want to introduce new product to our products family, if we are planning to increase production by adding new machine, in case we are planning to enter new markets, if we are planning to replace old machinery with new automatic machinery, in case we want to our source parts of components, etc. Then we are going to discuss about process of capital budgeting. For capital budgeting, there are some steps. First step is expecting or calculating cash flows. First step of capital budgeting is calculating the expected cash inflows and outflows. To estimate the cash inflow, every business has to identify the expected sale amount, expected current expenses, cost of capital, and other expenses. In business, cash inflow occurs from selling and outflow occurs from current expenses, cost of capital, and form of other expenses. We can find out net cash inflow from this sales revenue. In the same way, cash outflow occur from different expenses. Estimation requires finding out the current cost and fixed cost. Total cash outflow is subtracted from the total cash inflow. Second step, discount rate measurement. By the use of discount rate, estimated cash flow will have to be converted into a present value. Through this discounting process, present value of the future cash flows can be calculated. If present value of cash inflow is higher than the present value of cash outflow, then this investment decision can be taken. Generally, in capital budgeting decision, cost of capital can be considered as discount rate. And the last step is capital budgeting technique selection and application. After the estimation of cash inflow and discount rate, capital budgeting technique is selected. Different techniques of capital budgeting are being used in project selection. In this class, we are going to discuss the technique of one of the technique of capital budgeting, that is average rate of return. There are 4 techniques of capital budgeting. These are average rate of return, payback period, net present value, and internal rate of return. Average rate of return. It is a method of investment appraisal which determines return on investment by totaling the cash flows over the years for which the money was invested and dividing the amount by the number of years. This type of techniques relies on the accounting net income of a project and does not consider the expected cash flows. If average net profit is divided by the average investment, then average rate of profit or average rate of return comes out. Generally, net profit is obtained by deducting all expenses including tax from sales. Here, average net profit equal to sum of net profits divided by number of years, and average investment equal to initial investment plus salvage value divided by 2. If there is no salvage value, then average investment's formula will be initial investment divided by 2. So, the formula for calculating average rate of return is average net profit divided by average investment multiplied by 100. And the decision criteria is the more the ARR, the better. Consider the project. If ARR is greater than company's benchmark ARR, and we should refuse the project if our calculated ARR is less than the company's benchmark ARR. Here is the example for our better understanding. Mr. Tahir is the financial manager of ABC Limited. He is thinking of investing in a new project. The initial investment of the project is Taka 32,000 and the salvage value is Taka 7,000. The lifespan of a project is 5 years. From the first to fifth year of the project, depreciation and pre-tax profit will be Taka 10,000, 12,000, 15,000, 20,000 and 25,000 respectively. Tax rate is 40%. We have to determine average rate of return and give decision about investment if managing authority set benchmark ARR 20%. In this solution, at first we have to determine depreciation as profit. Given here is the pre-depreciation and pre-tax profit. So we have to determine depreciation per year. We know the formula of depreciation is initial investment of the project minus salvage value divided by lifespan of the project. Here initial investment of the project is 32,000 taka and salvage value is 7,000 taka. So 32,000 minus 7,000 divided by 5, we get 25,000 divided by 5 equal to 5,000 taka per year. Now we need to determine the net profit after depreciation and tax. Here we are drawing a table and putting depreciation pre-tax profit in the table. We are writing the amounts per year 1, year 2, year 3, 4 and 5. 10,000, 12,000, 15,000, 20,000 and 25,000. Then we are subtracting depreciation from it 5,000 per year. After subtracting depreciation, we get 5,000, 7,000, 10,000, 15,000 and 20,000. After that, we are subtracting tax of 40%. That is 5,000 into 40% equal to 2,000. 7,000 into 40% equal to 2,800. 10,000 into 40% equal to 4,000. 15,000 into 40% equal to 6,000. 20,000 into 40% equal to 8,000. After that, we get net profit per year 3,000, 4,200, 6,000, 9,000 and 12,000. So, we know average net profit equal to sum of the net profits divided by number of years. This is 3,000 plus 4,200 plus 6,009 plus 9,000 plus 12,000 divided by 5. 34,200 divided by 5 equal to 6,840 taka. The average net profit is 6,840 taka. And average investment equal to 32,000 plus 7,000 divided by 2 equal to 19,500. So, for putting these values in the formula of ARR, we can easily calculate ARR. 6,840 divided by 19,500 into 100 equal to 35.08%. And now, as our calculated ARR is 35.08%, which is above our benchmark ARR 20%, the project is profitable and we should accept the project. This is beneficial for our company. I hope you are understanding the average rate of return calculation. If it is useful to you and you understand that, here is 2 homework for you. I hope you will do it and inbox in my messenger. Thank you.